Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Apologize for the delay on the Econ show. Unfortunately, we had some family emergencies and a death in the family, so I wasn't able to get this assembled. So I know everyone is excited to hear what we have to say, but I apologize for the delay. Luckily, it does work in our favor. We were able to pick up some additional data from today, which I think is important to kind of build that full picture. And what that picture is that we're going to really go through. So in the first segment, we're going to have our normal 5 segments. And in the first segment, the global economy growth estimates, they've continued to get taken down. And we want to look at what's happening with food. We talked about it on Friday. We want to talk about it again today. We want to look at what's happening with growth and in rates. And then we've had a lot of data come out from the US looking at wages, looking at inflation, as well as PPI, or producer price increases index. So we want to look at how is that adjusting, and then that leads us into the update on wages. What is that doing for spending power? And now Europe is finally starting to see their growth estimates come down. You're seeing some of that weakness coming into Q4. That is something that we've been talking about, looking at Germany specifically. That's going to be a bit of that drag. And then the issues in China just continue to mount, which we want to look at what is happening in China, but also some of the good spots of what happened with India, Japan, and South Korea. So we'll try to go a little bit faster, just because we have, just so that you don't get too bored and walk away from us. But one of the things that we wanted to look at is stagflation. So when you look at Citi's economic and inflation surprise for the G10, you can see where this negative growth is coming in, where when you look at inflation surprises are going higher, and it's the highest that it's been, going back through the 80s. And then when you look at economic surprises to the downside, we're getting this very negative reading where growth is coming in, all of these economic leading indicators, current indicators, past lagging indicators are all surprising to the downside, while inflation continues to surprise to the upside. So what does that mean? You have that, and as we said previously, we're past peak growth. We've hit peak growth, and now the question is, where does growth settle out? Because as we've said time and time again, we don't think we get a contraction. Like, we don't think we come into a contracting market. It's just growth estimates are too high and have to come down as we see some of these adjustments. And as well, as inflation continues to ramp up, that's going to then, again, impact how much people can consume and what their consumption is going to look like, unless wages can really accelerate. But then if wages accelerate, well, then so do prices, which then also pushes up inflation. So it's this catch-22 a cycle of which comes first, or are they trying to do everything possible to keep prices from moving even further up? And when you look at credit impulses, so when you look at the G3 credit impulse, you continue to see these risks getting priced into the market, because credit impulses, which is that leading indicator, continue to be lower than they have been since obviously they were down in 2019, as we were talking about with what the issues were in 2019. But then when you look back to 2011, 2012, and it's not that we're going to see credit impulses go lower, because I don't think we do, but I don't think they go up either. And that's because we're seeing some liquidity come out of the market. You're starting to see some of this semblance of tightening. Again, tightening is a wrong word, just less easing. So you could say it's still going to be super easy in terms of financial conditions, but it's just not going to be as easy as it's been, which is going to protect that. But that's where we expect to see some of this normalcy and some of this slowdown, which will continue to get priced in, that the economic data is showing. What is being done to offset that in the U.S.? Well, share buybacks return with a vengeance to be the highest. The repurchase authorizations is the highest ever. And just when you think it doesn't get any crazier, this is when stocks are either at or maybe 5% off of all-time highs. So you're looking at buying stock at massively over very elevated pricing. But again, they have to keep the party going. So this is just looking at on a US side. So we had the G10. Now we want to look at the US. So this is the US City Economic Surprise Index minus the US City Inflation Surprise Index. And you can see that this is essentially the lowest point that we've been at going back. I mean, obviously it happened with COVID, but in 2011, again in 2009, 2008, and at the beginning of 2003. So you're seeing just the amount of inconsistency in the data, where the estimates continue to show one thing, and then then the data comes out and it's like, this is why you're wrong. And this is where you continue to see these shifting narratives in order to try to show or explain why we are. But realistically, inflation is going the wrong way. Economic data is going the wrong way, and especially against estimates. Again, it's moving the wrong way in a sense of, instead of growing at 3%, we're growing at 1.5%. It's still positive, but it's still above what the estimates are showing and realistically capturing what the market or what the participants are thinking. Inflation surprises continue to look much worse than the economic surprises. Inflation surprise and economic surprise indexes has bounced off recent lows, but still deeply negative, which again is also accounting for some of these adjustments. So the IMF has made some adjustments in general. And when you look at what the expectations are for the world, so advanced economies are the only income group expected to return to pre-pandemic trends by 2022. So world growth will still be about 2.3% below where they were pre-pandemic. Emerging markets and developed economies, excluding China, minus 5.5. China, we still think is elevated, but again, you're seeing how the advanced economies were able to achieve this from that massive stimulus. But as we keep talking about, there's also a fiscal drag created, and that fiscal drag has a bigger impact with how we purchase, how are we buying things, how is the consumer going to change, which again comes down to and keeps some of these impacts elevated across the supply chain, which again starts to be with a lot of these emerging markets. Now, the UN, so on Friday, we showed you what the global food price was. So this is, again, the UN food price, which is back up to the highs essentially the highs that we haven't seen since 2009, 2010. And then we hit it briefly in 06, 07. The problem is it won't be brief this time. And the reason why I say that is because, some of the data on the grains remains a bit mixed. When you look at what WASDE had for the US for beans and corn, it was fairly bearish pricing. On wheat, it was bullish pricing just based on what the expectations were. But things continue to get worse in Latin America. And again, that is keeping some of this bid. And now take that to the next level. You have a lot of fertilizer producers that have shut down in Europe due to natural gas prices and just input costs, which is also taking some of this volume out of the market and driving up fertilizer prices, which is also means that then farmers panic that there's not going to be as much available. They rush out and try to secure volumes at a much higher rate, and then that is going to come down to what is the price this corn or this crop has to sell at. And now Deere just had their first strike since 1986 because they weren't able to come to an agreement over wages with the UAW, which is something that, not to say that that's going to show up immediately, but that will create additional issues when you look at shortfalls that have already hit the market in general. So when we look at ending stocks, so this is looking at WASDE. So corn, the trade expectation was 298. It came in at 301. Soybeans expectation was for 100, came in at 104. Wheat, the expectation was for 280, came in at 277. So again, that's where I'm talking about some of the shifts where corn and beans was a bit on the bearish side. Wheat remains on the bullish side, but all crops remain elevated in general as we continue to see vessels carrying soybeans coming from Brazil and moving and shifting their way into China as China continues to purchase as many grains as possible. And a lot of that continues to come, but you're starting to see it tail off, but there's still a lot. You can see the Strait of Malacca, which is where you get that bottleneck coming between Indonesia and Malaysia. So this is where you'll continue to see that move up, and that will flow into the Asian markets. Now, this is, I remember last on Friday, we talked about U.S. North America fertilizer prices. Well, let's look at Brazil fertilizer prices, which have doubled in 12 months. Again, increasing the cost for what is happening in Brazil. And this is likely to switch and decrease corn volume and increase soybean volume, because remember, soybeans are being sold into Asia at a growing clip, and it's just going to cost too much to raise corn. So you will see some of those acres. The early estimates are for 3 million acres. I don't know if it's 3. It's just we do expect to see some of that shift in general. And then when you look at negative yielding debt, so the value of global negative yielding debt continued to decline sharply, now at the lowest since May 2021. And this is just as inflation expectations go up, as you start to see some of these movements, these surprises, you're starting to see rates go back up, or I should say yields going back up, which is pushing prices down, again, bringing some of that negative yielding debt to, and not to say that on a real basis, it isn't still negative. It's just on the nominal side, it is now getting less and less, with the remaining amount being the case. About 12% is negative yielding in France, 16% in Germany, and then Euro, ex-Germany, France, 23%, and then Japan. So as you can see, Europe and Japan are the largest drivers of that negative yielding debt still, but that's going to be something to watch as growth gets impacted while inflation goes up in Europe, and what does that do to some of the rates in general. And then when you look at the resource exports, because as we've been talking about with exports, and this is specifically looking at Australia, you've seen that big increase in general when you look at what has been exported. Resources have exploded. You're getting additional Australian coal showing up in China, even though technically they still have their little spat going on. But metal ores and minerals, coal, coking, and briquettes are at the highest they've been. When you look at coal and LNG exports were the primary drivers. When you look at metal ores and minerals, which again, that coal and coking, you're up and to the right, highest it's been. Then when you look at other mineral fuels, metals, you're starting to see that. And then the non-monetary gold, you're starting to see all of these move up, which will be supportive of the Australian backdrop, just given the shortages in the market and how they are really can have some of that swing production that is needed in the world. All the while, the U.S. Retailers' imports have been surging since surging since the financial crisis, highlighting global supply bottleneck pressures. Forecast is more parabolic. So retail imports millions of 20-foot equivalent units. You can see just how we flatlined for the most part, but now we're surging back up because we do have that shortage when we're looking at what is happening on the inventory side, and we'll talk more about that in segment 2 and 3. So then when you look at flooding, heavy rains has caused more flooding and deaths in China's prominent coal regions. So the Shanxi province has seen additional coal mines shut. Some of that is starting to come back online, but it's been very slow, which is creating an even bigger problem versus where it was as coal prices remain elevated in China, again, creating more of that strife on pricing. But it also comes down to where some of these other prices are in general. And the prices of DRAM versus NAND chips have come off recent highs, but you're starting to see some of the shifts in general where DRAM spot price has come down more aggressively than NAND flash. And it's just coming down to where is the shortages, where is the supply. It's still elevated. We're at about 22 weeks for delivery, just giving an idea that we're already well into 2022 for the delivery side. You're getting shortfalls, again, speaking to Germany, when you look at production, the ability to create cars, build cars, a lot of those headwinds remain in the market and continue to be a problem on the infrastructure and construction side and assembly industrial, which again is some of the backdrop that we've been highlighting, where that is going to be this inflationary push as the U.S. is forced to import ever increasing prices. Some of them are normalizing while others are going up. We had a drop in rates coming out of China. That is going to be a net positive. But at the same time, we have a big increase in input prices, so the stuff on the boat will be more expensive, even though the boat getting it from point A to point B will be cheaper. So those are things that we're going to talk about as well in the next segment.